again, the buyer's motivation for representations are to ask the seller to paint a picture about their company.
Right. So let's make sure you explain what a representation is and what a warranty is.
A representation or warranty, I mean, it's frankly, essentially the same thing.
Yeah.
Right. Those are factual statements about your company and the historic truth about your company. At least, hopefully, that's the case.
Right.
Right. And so there, in any purchase agreement, if you take the middle third, there's going to be 15 to 25 pages of these factual statements. My company has no litigation.
Yep.
My company has paid all its employee benefits on time. It's just over and over on all kinds of subjects. And they're doing this because they're saying, look, we think we know what your company looks like. And you have told us a lot about what your company looks like. And based on that, we've agreed to pay you X.
Yep.
If it turns out that your company doesn't really look like that, then we've probably paid you too much.
Right.
Right. So we're going to ask you to confirm all of these statements about your company. And then through what is called the indemnity provision, if one or two or three prove to be inaccurate, we're going to have the right to come back and get some money from you based on how inaccurate it happens to be. So in a nutshell, from a buyer's perspective, that's what the reps are. That's what they're trying to accomplish, is to make sure that the picture you're painting about your business is an accurate representation of that business.
We had Doug Starcher, managing partner with Nelson Mullins, on the podcast today. Doug is a seasoned M&A attorney, having spent the last 35 years doing deal work. And when I say M&A attorney, I mean that. It's a very unique discipline. It sort of conjoins a number of different areas: employment law, contract law, business law, and several others into one. So it requires someone who understands a lot of nuance, understands the dynamics of contract law, understands how businesses function, understands enough about the math behind it, knows where to sort of bring in an investment banker and where to sort of stay out. And Doug does that very, very elegantly. We've done probably 25 deals together. I don't know that we've done more deals with an M&A attorney, more so than with Doug and his team. Doug's also been through a transaction. When we met him many years ago, he was with Broad and Cassell, and he talked a little bit about how law firms sort of transact. They don't tend to get acquired, they tend to merge, which is an interesting dynamic. I think we covered a lot of ground today. We really focused on demystifying the language of M&A, especially within the context of the legal piece, which is probably the most challenging part, that language. We talked about indemnification and reps and warranties and disclosure schedules and networking capital targets. And again, difficult ground to cover. Hopefully we did so in a way that is understandable to those who don't operate in this area every day. That is our goal. Please let me know if I accomplished that goal. I think we did today. Thanks, guys. Welcome to Closing Remarks. I am your host, Dara Shareef, and we have with us today Doug Starcher. Doug, introduce yourself, please.
Thank you, Dara. Yeah, my name is Doug Starcher. I'm the managing partner of the Orlando office of Nelson Mullins. I run our statewide M&A practice. I've been a corporate attorney for 35 years.
35 years. You don't look it.
All right. Well, thank you.
I'm heading to my 35th high school reunion. I hate to say that out loud. That's happening in the next couple of weeks. But apparently I'm old enough to have gone to high school 35 years ago.
It's time flies.
It does. It does. So I've got I think a complex mission today. So our goal is to demystify the language of M&A, which has become too esoteric. A lot of that lives in the legal language. So my job is to hopefully extract these sort of answers out of you that will demystify the language without two deal guys getting into the weeds. Right. Which is the exact opposite of our mandate on this podcast. So that's my mission. So let's talk about sort of what an M&A attorney sort of does. It's really the confluence of like corporate law, contract law, employment law. It's a very unique set of skills required to become an M&A attorney.
Well, Thank you. I think it is.
Yeah.
Yeah, I think that's right. And really, we view ourselves, or at least I view myself, as a bit of the quarterback, because to know everything about all of those subjects
Yeah.
is impossible, and people who try to play cowboy get in trouble.
Yeah.
So
We've seen it.
yeah, yeah. So I'm identifying the issues that have to bring in specialists to answer specific questions, but otherwise trying to control the process in all those areas.
And you have a robust team, right? You're bringing
Oh,
in
yes.
resources in and around your team, not just paralegals, but specialists.
Yeah, absolutely. Yeah, we have over 1,100 lawyers in the firm, so there is somebody who does what we need all day long as their job, and
Yeah.
so I need them for 15 minutes, and I bring them in, and we solve the problem and move on.
And you guys actually went through a transaction. So when we were
We did.
we first got together. I mean, we've been knowing to each other for a dozen years, doing deals together. I think we've done more deals with you than anyone else on the planet. So you were Nelson Mullins back then.
Well, at Broad and Cassell.
Broad and Cassell back then.
Yes.
Sorry, it became Nelson
Yeah,
Mullins.
Broad and
Yeah.
Cassell, which is a statewide law firm, but
Yeah.
we weren't outside of Florida, and that was in 2018. that
Right.
We merged with Nelson Mullins, and now we're national.
Now you're national, and that's very much a way of expanding in the legal profession.
Yeah, it absolutely is, and it's tricky. You have to have a common philosophy of
Yeah.
practice and a few other things to make it work. But so far, so good.
We've seen that not go well, actually, where, you have these different cultures. You have these, it's like, oh, did you get, I don't want to say the firm specifically, but I bet you and I both know who I'm talking about, where if you get one office, you have a very different experience than if you get one that's only 50 miles away
Yeah,
because of acquisition, right?
Right,
And the
right.
lack of integration.
yeah, and firms forever have been trying to move into Florida, and there have been as many failures as successes.
Very parochial.
Yeah.
You don't think of Florida as being parochial like you would in the Northeast, where you go to Boston. It's like, if you're not a Boston guy, you're
Right.
kind of out of luck, right? But we have a lot of that here as well.
Yeah, we do.
So let's talk about sort of the role of an M&A attorney. Like, what is it that you're protecting against? What's the most important thing for the M&A attorney?
Yeah, I typically have a little spiel I give at the beginning just to set the table of what I'm trying to do, and I'm trying to be a protector, and that protector is what does the seller in particular want out of this deal, and what are they expecting it to say at the end, and I need to protect them to get them to that point. The other thing is I'm trying to be an educator or a translator, maybe.
Yeah.
To the point of how you introduced this topic. You know, there are a lot of words that people can read and think they know what it means, but there are implications behind those words
Yeah.
that my job is to explain those implications and then get decisions from the business owner. All right, I'm okay with that, or boy, I'm not okay with that. I didn't know that was what was going to happen. So I'm trying to do those two things and get to the end. And at the end, the seller knows this is the deal I signed up for. This is the deal I agreed to, and there are going to be hopefully very few surprises.
And we often will see the buyer bringing the A-team, right? So the buyers are professional buyers almost always, right? They've done it before. They're set up to do this. This is what they do for a living, perhaps,
Yes.
or they have a corporate development arm. This is all they do. And they have a relationship with Skadden Arps or, Morgan Lewis and Bacchus or one of these large sort of institutional law firms.
Yes.
And sellers will often say, well, I've got a relationship with my guy. He did my will. He did my estates. He did a real estate transaction. How could this be that much different?
Right.
And, he is quickly disabused of that notion because he gets his clock cleaned, right? So talk about sort of, going up against these world-class law firms and, what it requires on the sell side.
Yeah. And by the way, to your point, I'm not sure they know they get their clock clean,
Right.
which is the scary part.
Yeah, that's true.
And in fact,
Good point.
you kind of taught me that, or your group did when we first started getting together. In my mind, I would have thought that a group like Benchmark would have been okay with the brother-in-law doing the deal because the brother-in-law wouldn't have known what they were looking for.
Right.
And you said, no, absolutely not. Because they don't know what they're looking for, they challenge everything. And
Right.
the deal never gets done.
That's right.
So I think the importance of deal counsel and going against the people who do this every day is to have someone who does this every day.
Right.
And to know, again, what those words mean, what the implications of the provisions of the documents are. So we're not trying to figure it out on the fly. We're not, making mountains out of molehills. We know the important issues, and we're raising hopefully only the important issues that mean something in a dollar and cents kind of situation.
And that's an important distinction, right? Because we've seen lawyers sort of nickel and dime on the language. I wouldn't have drafted it that way.
Right.
It's like, okay,
Yeah.
that's okay. Does it say what it needs to say? Does it protect the buyer and seller in a way that's market that's fair?
Right.
And the best attorneys are trying to create a scenario where both sides can sort of live with it. There aren't any real gotchas there, but we don't always see that.
No, and I'm seeing that less and less, frankly. The professional buyer, I think, realizes how quickly the seller does get deal fatigue.
Yeah.
And they push things off to the end to know that I can get these important provisions by them, and I can get what I need. And I'm seeing that on a couple of deals I'm working on now. And not to plug Benchmark too much, but I'm happy to do it because what you guys do to really help me is to stand with me. I'm not the only bad guy, right? So I need someone else to tell the seller, no, this is really important. They save these dollar and cents conversations to the very end because they know at this point you might not care as much.
Right.
You just want this over with.
Yep.
And if I'm the only one standing in the hedge trying to stop them, it gets a little tiring. So you guys do a great job at that, and I appreciate it.
Well, we appreciate the kind words, certainly, and any Benchmark plug we will take and clip and make sure it goes viral. That is the idea of this podcast. So let's start with the LOI. That's often when you get involved. We'll be the ones negotiating the LOI typically, and then you come in. My view is the LOI sort of like directionally tells the lawyer kind of what's been contemplated to this point,
right?
But should not sort of have legal language in there that kind of gets in your way. So I see language like, reps and warranties and indemnification, all this stuff that we'll get into in the LOI, not even binding language. And we know it's just going to create traps later. We know that even signing it doesn't really mean much. Even if they agree to it, the buyer doesn't know what the risk profiles are yet because they haven't done their diligence. Right. So talk about the LOI, kind of what that document means and how it sort of, leads carves out a path to the purchase agreement.
Yeah. Well, and that's it. I think the path is the best word to use. I don't get overly hung up on LOIs for the reasons that you mentioned, but they are important because they do set you off in a direction.
Yeah.
And you don't want to be marching in a direction and then have to say, just kidding. We want to go somewhere else. But there are also some clues as to what the buyer is thinking in the LOI that you can talk about up front without negotiating the whole deal. So yes, the LOI is important with, first, of course, how much are you going to pay for this company? What's the structure of that payment? How are you going to carve that up? Are you just going to give me a bunch of cash or is it going to be contingent on things? Those are pretty key differences.
Yeah. So
we can talk about that in the LOI, and it's important to get those kinds of terms nailed down. But things like reps and warranties and indemnities, most LOIs, they're just going to have a sentence that says, and we'll negotiate normal types of provisions later on.
Right. And when I see a complex, paragraph on that, I just cross it out. I just cross it out. We're not lawyers. And, my view is let's try not to get the lawyers sort of marking up the LOI because there's so much work to do afterwards. And not every lawyer agrees with me on that.
Yeah. Well, I may not agree with you on that.
Yeah, it's okay.
Yeah. So I don't try to over negotiate the LOI. I mean, if you're doing the LOI for more than a couple of days, once it hits me, you're probably doing it for more than a few days.
We are.
But once it comes to me, if we're negotiating that for more than a couple of days, we're kind of missing the boat. We can deal with most of those things later on, but there are some things that are important to make sure that everyone understands what this means. And again, what path are we heading down?
So let's get back to the mandate here, and that's to demystify the language. So let's talk about some of the areas where you get involved that where the payout might be kind of at risk. So let's talk about networking capital and maybe taxation. Okay. Right. So networking capital. Just explain to our audience what networking capital is within the context of an M&A transaction.
Okay. And this is the demystification.
Yes.
Okay.
That's
great.
right.
Well, and you guys know net working capital as well as I
We
do.
do.
But so net working capital is the concept that the buyer is purchasing a going concern. They're not just taking a bunch of assets and starting a business from scratch with no money coming in the door,
Right.
no bills they have to pay. They want to buy not only the car, but they want to buy the car with gas in it,
Yes.
and so they can drive it off the lot.
Right.
Uh, so they need to understand how much AR is historically uh, accurate as far as the company is concerned.
Accounts receivable.
Yeah,
Yep.
accounts receivable, accounts payable, certain accruals, and they want to understand that what they're buying on the date of closing is consistent with how this company operates in the past.
Yeah.
They don't want a seller to accelerate as much AR as possible, put all the money in their pocket,
Right.
so when they get there, there's nothing coming in the door. They don't want someone taking all the payables and sticking them in a drawer and
Right.
saying after closing, buyer, that's your problem. You pay them.
Right.
So there's going to be a comparison to what that historical net working capital is to what it actually is on the date of closing. And in most cases, then there's a purchase price adjustment up or down. If you deliver more working capital than you historically need to operate, you get a price increase, and that's great for the seller.
Yeah.
If you deliver less, you're going to get a price decrease.
Right. So you have no incentive to accelerate the collection
that's
of,
right.
of receivables. Hey, I'll just give me 80% of what you owe me. I'll just take it in now, and leaving a
Right.
business that is not able to fund itself.
That's right. The buyer doesn't want to buy the business and then turn around and have to dump a lot of money in it. Yeah, ordinary course. That's what we're looking for.
So exactly. So from a taxation perspective, let's talk a little bit about how the structure of the very basics transaction structure. So an asset deal or a stock membership interest deal,
Right.
equity deal, we'll call it. And then also there are these little gotchas, which are sort of stock deals with an election, a tax election, where they get treated like an asset deal. If you could just sort of give us very basics of the difference between the tax treatment of an asset deal versus an equity deal.
Sure. So a typical equity deal, whether that would be a C corp or an S corp, and we'll talk about partnership equity in a second, or LLC equity in a second. An LLC can be an S corp, frankly, can be a C corp. But if you're selling stock, then your taxation is going to be at capital gains rates. If you are selling an LLC interest and that LLC is taxed as a partnership, then you will essentially be taxed as if you had sold assets. The difference is that when you sell assets or when you sell partnership interests, the IRS makes you allocate the price across various classes of the assets in your business. Some of those asset classes are taxed at ordinary income rates. So if you had sold just your stock, then it's all capital gains. But if you sell your partnership equity, a lot of it may be capital gains, but some of it may be ordinary income. So that's at a high level, that's the basic difference.
And we're talking about almost a 20% difference, right? At the very top level, when you're talking about sort of 20% plus the ACA rider, which is what, 3.6 or
3.8%. Yeah, would apply to passive investors.
Right.
So anyone active.
So then you have ordinary income for a deal that's, $20-30 million. You're going to talk about a chunky
at least
component.
17%.
Yeah.
17-8%. That's a big difference.
It is. It's a big difference. Something they need to absolutely consider. So this is probably a good transition into sort of what is required on the sell side to make sure that the seller is protected from a tax perspective. And a lot of folks will say, hey, I have a CPA, is very good. And I'll always say that a CPA will have no idea how to handle the complexity of an M&A transaction on the tax side anywhere near as competently as someone with an LLM.
Right.
And it's usually from one of a couple, there's like 3 schools where they all come from. And, you and I both know what they are. And you have one on your team who is absolutely fantastic. We've used him and we've used Pete so many times. Talk about sort of why it's so critical to have an M&A tax lawyer on your team and not just a CPA.
Yeah. Well, for that reason, a tax lawyer is thinking about things from a transactional basis, not a reporting basis. and I'm not going to denigrate the entire accounting profession, but we've run into accountants that just don't want to get involved in the M&A process because that's not where they live. And
Those are the best versions, by the way. They know where their limitations are.
yeah.
We run into those who don't know that, and that's where they become a real problem.
Okay. Well, so I know enough to have this conversation and have it fairly deeply, but
Yeah.
but there are issues that are going to come up that you need either a partnership tax specialist or a corporate tax specialist to understand again what the implication is to the sellers, because now you're talking about real dollars.
Yeah.
Taxes is a big part of the difference between that gross price that you see in the LOI and that net price that ends up in a seller's pocket. Ultimately, what's important is what ends up in the seller's pocket.
Yeah.
So we need to make sure that we are helping structure the deal in a way that maximizes that net.
Definitely. No doubt. So we've talked about sort of payout risk.
Mhm.
Let's talk about sort of clawback risk, right? So let's talk about reps and warranties, indemnification. Let's talk about it in a way that's not, a couple of guys talking about M&A who know what they're talking about, but in the language that sellers would understand, because this is really some of the nitty gritty and why you want to have a pure play M&A attorney on your side.
Sure. So again, the buyer's motivation for representations are to ask the seller to paint a picture about their company.
Right. So let's make sure you explain what a representation is and what a warranty is. Yeah.
A representation or warranty, I mean, it's frankly, essentially the same thing.
Yeah.
Right. Those are factual statements about your company and the historic truth about your company. At least, hopefully, that's the case.
Right.
Right. And so there, in any purchase agreement, if you take the middle third, there's going to be 15 to 25 pages of these factual statements. My company has no litigation.
Yeah.
My company has paid all its employee benefits on time. It's just over and over on all kinds of subjects. And they're doing this because they're saying, look, we think we know what your company looks like. And you have told us a lot about what your company looks like. And based on that, we've agreed to pay you X.
Yeah.
If it turns out that your company doesn't really look like that, then we've probably paid you too much.
Right.
Right. So we're going to ask you to confirm all of these statements about your company. And then through what is called the indemnity provision, if one or two or three prove to be inaccurate, we're going to have the right to come back and get some money from you based on how inaccurate it happens to be. So in a nutshell, from a buyer's perspective, that's what the reps are. That's what they're trying to accomplish, is to make sure that the picture you're painting about your business is an accurate representation of that business.
And what are the remedies, right? What are the constructs that you use within the framework of an M&A deal? Obviously, you've got escrows and holdbacks. You also have caps and baskets and tipping baskets and deductibles and all of this crazy stuff that lives only in an M&A attorney's mind.
Yes,
transaction.
That's right. And thankfully, most of that has become fairly market, so that we don't have to recreate. We don't have to recreate the concept, but we do have to negotiate the specifics.
Yeah.
And so what you're referring to is, you would think, all right, so seller, you've told me that your company, that this factual statement X is true. Turns out factual statement is not true. Buyer says, that cost me $100. Buyer may say, since your company is actually worth, or that $100 would have been an expense, then since I paid you a multiple on your earnings, and your earnings subtract the expenses, I instead of $100, I paid you a 5 multiple. I want to subtract $500 and get that back. So there are those kinds of concepts. So what we need to do is limit the ability of the buyer to reach into your pocket and pull money back as best we can.
Yeah.
So some of those limitations are durational. So these representations can't go on forever.
Right.
I mean, at some point we need to know the money you've given us is ours. Right. So, anywhere from 12 to 24 months is generally acceptable. 12 is best for
Yeah.
the seller.
Yeah.
As you might expect, we fall at 18 an awful lot.
Yeah. Yeah.
So a durational limitation is one. Uh, you mentioned caps and baskets and all that. So we don't want the buyer nickel and diming us.
Right.
If it's a serious problem, fantastic. We'll own up to it. But if it's a $10 problem, $300 problem, whatever it is, don't talk to us every 3 days
Right.
about an issue. So we'll have a basket or a deductible, if you will. So and it says, buyer, you can't come after us and request reimbursement and request indemnity unless your damages exceed a certain amount.
Yep.
And there's two ways of doing that, and you alluded to them already. So one of the ways of doing that is once it exceeds that amount, then you can recover it all. So just sort of gather it together, and when it's big enough, you can ask for it.
Right.
The other way, more preferable to the seller, is once it exceeds that amount, then from that point forward, you can ask us for damage. So it's kind of like, cost of doing business, you're going to eat the first X dollars. And then after that, you can come after us. So that's on the front end. The back end is the cap. I don't want, if I own a business and I have limited liability as a business owner, I certainly don't want to sell my company and sign up for more liability than I would have to own my company.
Right.
Right. Okay. So at the very minimum, we're going to have a cap that says you can never recover from me more than you pay me.
Right.
Yeah. Because if everything falls apart today before I sell my company, that's all I'm going to be on the hook for anyway. Well, that's nice, but not good. So we would like to introduce caps on liability that are much lower than that, some percentage of the purchase price, whether and each deal is different because of the size of the deal. It makes sense, but we're talking, let's say 20% of the purchase price, right?
Yeah.
Instead of the full purchase price. Now there are exceptions to those rules. If there's actual fraud, there's not going to be any caps. There's not going to be any baskets.
Right.
Frankly, I've never seen it.
Yeah.
So many people go through these reps, and we haven't used the word disclosure schedules yet.
Yeah, that was next.
But that's something that we get heavily involved in helping the seller put together what are the exceptions to the reps. For example, my company has no active litigation except as disclosed on this schedule. Right. So we'll write down all the litigation, and what that does is takes a rep that would have been false and makes it true. So now we're okay.
Yeah. Almost a get out of jail free card. This is your sellers worry about disclosure schedules. We view it as their opportunity to get it out there, so you don't get whacked later on financially.
Yeah. Oh, you definitely want to disclose everything you can. That's right. Now, will a buyer say, "Well, hold on, thanks for telling me, but I'm not signing up for that," and want some kind of special indemnity?
Sure.
Yeah, and in cases that is true, but not in the great majority of cases. So you do want to disclose everything you can to make it accurate, and we're going to help a seller do that.
And there are significant parts of the reps and warranties that are within a purchase agreement that are kind of boilerplate. And rather than sort of making changes right inside the document, you set up a disclosure schedule, right? Rather than making edits right into the sections.
That's correct.
You actually make.
Yeah, it's a separate document that's attached to the purchase agreement, if you will. It's a disclosure schedule. Yeah.
So let's talk a little bit about the purchase agreement and then definitive agreements. So a lot of sellers will hear definitive agreements and they'll hear purchase agreements. So walk us through the difference there. Okay. Definitive agreements being sort of like purchase agreement plus all of the ancillary documents, right? Versus just sort of a single document. I think people get confused with that.
Yeah. Just to wear you down a little bit more, they don't put everything in one document.
They don't.
Right?
That's true. Okay.
So the purchase agreement is going to do what it sounds like it's going to do, and that's going to govern the terms of the acquisition of the equity or the acquisition of the assets, however the deal is structured. But there may also be a lease. Maybe the seller owns the property, or a company owned by the seller owns the property, and now a new lease needs to be entered into.
Mm-hmm.
Maybe the seller is going to be employed after the sale for some period of time. Now you have an employment agreement.
Yeah.
oftentimes a buyer is going to want the seller to have some skin in the game,
Mm-hmm.
and this is a big piece that I'm
Yeah.
sure is on your list there. But
Yeah.
and we'll call that a rollover, where the seller invests in the post-closing operation, and there are going to be agreements wrapped
Yeah.
around that particular transaction. So, yeah, so you've got a purchase agreement, but that's certainly not the only document that is involved in the closing.
Yeah. Non-competes and stock pledge agreements. I mean, sometimes there's 15 ancillary agreements.
There are,
You get,
and the buyer drives the complexity of the deal for the most part in either the structure or just how they want to set it up. Non-competes can be in the purchase agreement. Non-competes can be separate documents.
so Benchmark, you and I have worked together on, I would say 20 plus
Sure.
transactions. That's probably light, given how many deals we've done together. So I think we have a really good feel for sort of the handoff points, why it's really important to have a really good relationship between the M&A attorney and the investment banker, and what the focuses are for each and the handoffs, and where you kind of stay apart and let each other do their jobs. Why don't you sort of walk us through a little bit about those dynamics between the investment banker and the M&A attorney?
Yeah. I think I've mentioned to you before that I have clients that often come to me and say, "Hey, can you help me sell my company?" And I say, "Well, I can tell you what I can do."
Right.
But lawyers who say, "Sure, I'll go find a buyer for you," they are immediately out of their lane. Right? No, I probably know someone who could be interested,
Yeah.
but that person's probably my client. Now I've got an immediate conflict situation.
Right.
But I can't run the process that you run. I can't. I don't have the relationships that you have. So clearly, that's your lane. That's a benchmark scope, and I'm sitting there waiting for that LOI. As you mentioned earlier, that's where I would typically start to get involved. Is at the LOI stage, whether we're evaluating multiple LOIs, comparing them together, or just looking at one. Uh, and I guess it depends on how interesting the company is and how many people that you can attract.
Right.
And I know that's what you do. You go out and try to attract as many interested buyers as you can, have them sort of play off each other,
Right.
sharpen their pencils, and get the best possible
Yeah.
price. Again, I can't do that.
Right.
Right. All right. So then there's a diligence process, and if needed, we can set up a virtual data room, which is an online repository for all the documents that this company has, all its contracts, all its employment records, all that kind of stuff. So the buyer doesn't have to show up and sit in your conference room for a week looking at documents like
Right.
they used to do. They can do it all virtually and online. I know you guys set that up and run that process.
We do.
We could, but you're going to do it more efficiently. And frankly, we want to be accessing the room that you set up, because we're doing that to prepare the disclosure schedules that you mentioned earlier.
Right.
And you guys have a direct connection with the seller and have sort of been in his business more than we have at this point. And you know where some of these bodies are that you're extracting and putting up in the data room. Once we get to the purchase agreement, I kind of kick into higher gear at that point in time. And I'm dealing directly with the seller on some of those interpretation issues and all of the decision issues. Do you want, here's the provision in the document. We have two choices. Do you want to go left? Do you want to go right? And here's what that means. All right. But as you know, there are going to be times in which, boy, this is just not acceptable. And I can talk to the lawyer. I can't talk to the party, right? But you can talk to the party.
Right.
We don't want the seller talking to the party, because
No.
they're always going to get bullied and they're going to lose. So I can talk to the lawyer, and the lawyer's going to say, "Okay, I'll bring it back to my client." And, I know what that means. All right, but when we can get you involved, sort of coming in the back door and talking directly to the buyer,
Mm-hmm.
and saying this provision isn't going to apply for us, and here's why it's not going to
Yeah.
apply. That's extremely helpful, because now again, that's something I can't do. At the end, we do get to that networking capital process. And there are two components. One component, there's two primary elements that I'm looking for. One is the target number.
Yep.
So that's that historical average that we talked about a little earlier. And then the other is, well, what is it actually at closing? That's the comparison.
Yep.
Okay. I don't know what the numbers are. I can figure out what the elements are,
Yeah.
and they differ a little in every deal.
They do.
But I'm not doing the accounting work, and I don't know how to populate the actual spreadsheets. You do. I've worked with some M&A advisors that, one, don't have any interest in doing that, which means then I have to do it.
Right.
And I can, but I don't think I do it as well as you do, again, because I don't know what the numbers are. And I've worked with an advisor who says they can do it, but then they didn't really even understand what they were trying to do. Someone who would say something to me like, well, the goal is to make sure neither party has to pay the other. I said, well, that's not really the goal.
It isn't.
The goal is to get it right. And if they have to pay us more money because we delivered more, then I want that.
Right.
I don't want you manipulating this so everyone walks away and with no one writing a check. So that so there we go. We got the beginning where it's heavily you, the middle where it's heavily me, though I'm leaning on you where needed to go talk directly to the owner.
Yep.
And then at the end, you're coming back in pretty heavy again with the numbers. And that's when the seller has gotten tired. Boy, that's when they can give away money. And I hate that when that happens. So we're working together at the end, but I'm leaning on you at that point. So in my mind, that's an easy division of responsibility.
And one of the great things we can do if we have a good working relationship, like we obviously do, is that when we have an issue, I can work on the underlying business issue, and you can work on the sort of legal components of it.
Sure.
And we've done that so many times because usually it's not just a legal issue. Usually there is a challenge that's sort of impacting the business that you have to figure out how to apportion risk, and that's where you guys come in.
Right.
But we can sort of surface the actual underlying issue, talk to the buyer about it with the seller, and sort of figure out conceptually how we want to allocate risk, and then the lawyers will figure that how to paper it.
Yeah, that's right.
We've done that a number of times with your group for sure.
Yeah, and going back to that, the networking capital calculations that happen at the end, to me, there's nothing more satisfying than getting the seller to understand where he's giving away money and saving more money than I cost. Yeah,
right.
I mean, that's a home run.
Of course.
Yeah.
We've done that too. I mean, we've done that in networking capital, and we've seen a fee that's under $1 million and save them over $1 million in networking capital because they were getting ramrodded until we got into it.
Exactly.
So there's no doubt about it. Okay. So you mentioned retained equity, rollover equity. It's an important component because private equity funds almost always require some version of retained equity in a deal, and they're pretty prolific buyers. I want to sort of walk through the mechanics because you can do it in a number of ways. So what are the ways you tend to see a retained equity or rollover equity deal getting done? Talk about what it means to the seller. Take it any direction you want.
Yeah. Okay. Well, typically what you don't want to happen is for the seller to receive the cash, or from a tax perspective, be deemed to have received the cash.
Right.
Like they sold everything, and then turn around and reinvest that into the company.
Right.
When they do that, they're reinvesting post-tax money. We can structure it in a way where they're investing pre-tax money. Obviously, much better for us. There are certain buyer organizational structures that make that either difficult or impossible, but we don't run into them very often, especially with private equity. If private equity is going to have a partnership structure that we're investing into, we can always do it. We can roll over, and we'll talk a little bit about what that is in a second. We can roll over in a tax deferred way, meaning I'm not taxed today because I didn't really get anything.
Right.
Yeah. I'm going to be taxed later.
Yeah.
But not today. So a common rollover is 20%, 15, 20, 25 at the most kind of percent of the value of your business. So if my business is worth $100, I'm going to sell it for 80, and I'm going to roll over $20 into the new venture.
Mm-hmm.
Well, if I'm the first company that that the buyer has purchased, they're paying 80. I'm investing 20. So I'm investing 1/5, they're investing 4/5, and I should get 20%
Mm-hmm.
of the ongoing business. And then they're going to go out and buy other companies, and they're going, I did that math right.
Yeah, you
You're
did.
the math. Okay.
Yeah.
And they're going to buy other companies, and hopefully the next sale, when that buyer has created some critical mass and put together a portfolio of companies that someone else wants, they can sell it for a higher multiple than they bought us for. And even if it wasn't any more valuable,
Right.
I get more money because the multiple's higher.
Yeah.
But if it is more valuable, now I get a lot more money. So I've had situations where sellers have stayed on through a couple of different sales, and just had a smaller piece of the company each time. However, each sale produced as much or more money than they did the first time.
Yep.
Yeah.
I have too.
So it can be a great benefit. It's not guaranteed, right? The company has to do well. It has to do well essentially in the hands of the buyer, though if you're rolling over, you're staying involved and probably staying actively involved in running it. But if it does well, it could be a great deal.
Yeah, we've certainly seen that. We've seen a number of instances where the client made more money the second time around than the first.
Right.
And so you have to sign up for some real changes, right? I mean, you might, if it's a tuck-in versus an add-on, you might lose the brand, right? So there's some other implications as well. But, you get governance, you get a board, you get jet fuel to go adding on to your platform, right? It's a very different approach than a strategic might take.
That's right. That's right. And yeah, they're not in it to maintain the status quo or to lose money, right? So they're going to do, they being the buyer, they're going to do what they can as a private equity buyer to increase the value, but they also know they're not the operator that
Right.
you are. So they're going, that's, I think there's a lingering horror story from years and years ago that, boy, if you get bought by private equity, they're just going to dismantle you and sell you off for parts. Well, I've never seen that happen. Because they want you to continue operating. They're going to help you as much as they can so that whatever you were doing before to be successful, now you can be more successful so they can sell you for a higher price.
Makes all the sense in the world to me, but of course I'm in this industry every day, so I see it just like you do. So we're here to benefit the business owner. So if you were going to interview potential M&A attorneys for your business, put yourself in their shoes, how would you go about vetting them? What are the questions you'd ask to sort of unpack what their background is, why they're the right fit, that they don't deviate, that they're not out there, doing real estate deals and doing an occasional, internal counsel stuff for their clients, like that this is what they do for a living?
Yeah. I would ask two questions.
Okay.
And I'll get to kind of where you were driving at the second one. But the first question I would ask is, what is the depth of your bench? Going back to something we talked about at the very top of this conversation, I can't do it all. So even if I'm a really good M&A lawyer, I don't know a whole lot about ERISA that's going to help you. Right. And privacy laws are changing every 5 minutes. So I need people that's where they live every day. So the question I think is important to ask me is, all right, do you have specialists that can deal in all, or that do every day deal in all the areas that I'm going to need to do this deal? And tax is obviously a big one. And it's not just, do you have someone who knows taxes? Do you have a corporate partnership tax person? That's what they do every day. Do you have an IP person? That's what they do every day. Do you have an employment labor person? That's what they do every day. So, you don't need 1,100 of the Nelson Mullins lawyers, but you probably need 8 of them.
Right.
Right. And if you have a firm that doesn't have those people, and that's one of the reasons we went from 175 person law firm that you knew us as Brody Cassell, to where we are now is, we had some people that kind of dabbled in these niche areas, but didn't live there every moment of every day. Now I do. So it is extremely helpful as far as the actual process and getting the best result for the seller. So then the second question, which you were touching on is, do I dabble in M&A deals and mostly do something else and not know what I don't know? So I think the question is, all right, how many of these have you done? And that's not always important, but in an M&A context, I think it's important.
Kind of important.
Yeah. Yeah.
Yeah. What's a good number? Like, what is it? What is a strong number sort of annually?
Personally, annually?
Yeah.
Well, you know,
Up to you.
yeah, 20,
Okay.
let's say you
That's
do.
that's a lot of deals.
Yeah. But, it's just how many have you done? And let me
Mm.
talk to a few of the people that you've represented to understand what the process is. And they should be happy to say, all right, yeah, I'll give you 5 names. Here you go. Go talk to them and see how we did. Um, but really it just comes down to how is this something that you do every day so that you're comfortable with it and you know what the buyers are going to require, sort of the games they're going to play.
Right.
um, and it's not just, hey, I can read corporate words and kind of figure them out.
Right.
That's Yeah, a lot of people can do that, but that's not the most important part. The most important part is, what other words should those be, as opposed to what they are. If that
Yeah,
makes any
it's
sense.
M&A is its own thing, right? So it's, you just don't know what you don't know. A very competent corporate attorney could probably get, sort of 80-90% of the deal done and figure out a lot of it. But there's some stuff in there that's just very much in the day-to-day of doing this work. And especially the sort of what's market and what isn't. Like, you couldn't possibly fathom what's market and what isn't unless you do this every day.
No, that's right.
And
That's right.
that's the challenge that we see, of course.
Yeah. And yeah, a great example would be the tax issues that we talked about, and the taxability of certain deals. And I don't know. I don't think it is common knowledge that if I sell equity, I potentially, in certain circumstances, could be taxed at ordinary income rates on certain things.
Yeah.
And those, we didn't get into this level of detail, and maybe we shouldn't, but one of those categories is kind of your fixed assets, your FF&E, and that's an ordinary income category.
Yeah.
Well, so why this is important is the buyer wants that number to be as high as possible so they can depreciate it again.
Yeah.
The seller wants it to be as low as possible because that's an ordinary income category, and they want to minimize the gain. So there's a natural tension there.
There is.
And unless you know that, you may be giving away a lot of money on behalf of your client, the seller, that you don't intend to give away.
Right. You don't know what you don't know.
Right.
That's a real challenge. So if you were sitting in my seat and you had a business owner who sold a business, right? So you're the interviewer at this point, and we're a week from now recording another podcast. What would be the question that you'd want to know the answer to of that business owner?
If they've already sold their business?
They have, yeah. So someone who's, we do a lot of interviews of folks who already sold the business. We're trying to talk to business owners through business owners.
Yep.
And, what's that question you think that might elicit a really useful response?
Yeah, I always think it's interesting to ask a business owner, all right, what did you think this process was before it started?
Huh. Yeah.
And how was it different?
Hmm.
And you ask that question and then just sit back, because they're going to ramble on for 45
27 minutes.
Yeah. Because no one has any idea how intense the process is going to be, how emotionally draining it's going to be. It is a full-time second job. They still have to run their business.
Yeah.
But selling a company is a full-time job. And it's not selling a house. You don't just show up and sign some papers
Right.
At the closing table and then take your check and go home. And I think there's a lot of people think that it's that simple, and which is part of the difficulty of marketing, because I can tell them all day long it's not like that, but in their mind they're thinking, well, why isn't it like that? I'm just going to turn over the keys and get the check. Which helps when you explain it to
Yes.
them that it's not like that.
Absolutely.
But yeah, I think that's always a fascinating answer, because I've asked that question multiple times to the business owners after the sales. Okay, what did you expect on the front end, and what did you get?
Great one. That's a great one. So we're putting together a bit of a repository of these questions. I started asking this question recently, and we're getting really good questions that we're going to pull out and ask future guests.
Okay.
Not sure who it'll be, but I will reference you when we ask that question for sure.
All right. Excellent.
So we're kind of wrapping up here. What would be sort of your closing remarks? That's the name of the podcast to a prospective, seller, a business owner, just thinking about doing a deal. And obviously from a legal perspective, what would be the sort of takeaways you'd want them to have from this podcast and just orienting their brain around what the risks are and things like that?
Selling your business is going to be the most important transaction that you do in a lifetime of transaction, right? You have built your business,
yeah,
and then you're going to sell it. Don't mess up at the end, right? Don't,
1 yard line,
right? Don't be penny wise and pound foolish
Yeah.
when you get to the most important part, and putting together that experienced team. Every member of the team costs something.
Yeah.
Right. You cost something. I cost something. Your CPA costs something.
Yeah.
But hopefully, every member of the team is bringing as much or more value to the transaction than they cost.
Yeah.
Right. I mean, you're going out and you're getting people to pay more for that company than they're ever going to get with unsolicited offers.
Of course.
No one's putting their best number on the table when there's no other competition. Right.
No.
And as we've spent, the entire time talking about, someone who doesn't understand the implications of all these types of provisions is not going to know how to help you. And almost all of the ones that we're going to focus on, and most of the ones we've talked about today, have real dollar and cents implications. It's not about my preference is to put a comma here instead of there. I mean, that's not good lawyering.
No.
But changing something that means another dollar in your pocket, seller, that's good lawyering. And that's what we're focusing on. And you need someone who knows how to do that. So assemble a team that has done this before.
No, it's great, sage guidance. And we certainly would support that. And I've said that a number of times, but it's great to hear someone else saying it because it sort of tells you the value of a benchmark, tells you the value of a Nelson Mullins and all the other folks who will be a part of a transaction team. Well, Doug, thanks for coming in. We really appreciate you helping us educate our audience. Again, some of this language is so intimidating, even for folks who are really, well-seasoned business owners. They haven't seen this stuff before. So you did a great job of sort of illuminating. So thank you again.
Well, thank you. Thanks for having me.
And remember, in business and in life, the best outcomes aren't found. They're built. Far too many business owners go into the most impactful financial transaction of their lives with both arms tied behind their backs. That's because they're operating at a severe disadvantage. Most business owners sell precisely one time, once. So not only do they not know the answers, in many cases, they don't know the questions to ask. And that isn't their fault. M&A has a language of its own. And no one has made a mission of ensuring business owners are as informed as their advisors and the buyer on the other side of the transaction. Until now. This podcast exists to serve that gap. But we can only fulfill our mission if this show finds those who could most benefit from its content. So please help us find those people. If you like this podcast, let us know. And let the world know. Hit the like button. Tell us what you learned in an episode or what you want us to cover next. Subscribe. Share it with someone who needs it. Help us close that gap.